The AI bubble has just cracked. Anthropic, the trillion-dollar crown jewel of the industry, has hit a wall, and that stall exposes the secret underlying the entire boom. This is a massive leveraged bet on your unemployment. So far, somewhere between $3 and $4 trillion has been poured into American AI. But this isn't just venture capital. The majority of that money is corporate debt, borrowed cash that doesn't care about a founder's vision, it only cares about interest. This diagram shows the baseline cost of that debt. At a standard corporate bond rate of 3 to 4%, the interest alone works out to roughly $100 billion a year. That is the entry fee the industry must pay just to keep the lights on and the lenders polite. Generating $100 billion in profit to cover that interest requires a staggering $1 trillion of annual revenue, assuming a healthy 10% profit margin. For an industry that currently loses money on nearly every request served, the climb to that trillion-dollar target is steep. There is only one pool of capital in the economy large enough to provide that $1 trillion, the $10 trillion white-collar wage economy. To survive its own debt, AI must capture 10% of every salary paid to accountants, paralegals, and analysts. This math reveals why tech leaders have spent years prophesying a job apocalypse. They weren't issuing a warning. They were pitching your unemployment to investors as the primary product. To avoid default, the industry's business plan requires the profitable deletion of 10 million human jobs every single year. To see how that plan is failing, look at Anthropic, the makers of Claude. Because Anthropic is a private, pure-play AI lab, its valuation serves as the reference price for the entire sector, the benchmark that dictates the value of the chips, the cloud providers, and the pension funds betting on AI. This chart shows Anthropic's revenue curve through early last year. By May, they reported $47 billion in annualized revenue, growing at 51% per month. Then came the summer. Third-party trackers show that monthly growth pace has flattened to roughly 8%. The line that went up like a rocket has turned into a man on a ladder taking a break. A $1 trillion valuation on a young company prepays for decades of imagined future perfection today. It is like buying a bakery for the price of every croissant it might ever sell until the year 2060. Delivering merely excellent growth is a failure when the market has already priced in a miracle. This stall creates a headwind for the entire tech ecosystem. When the poster child's curve bends, the repricing travels through the chip makers, the cloud giants, and the index funds that households rely on for their retirement. The promise of infinite acceleration is breaking. The machine is failing to hoover up those 10 million jobs for 3 specific reasons. First, the plan to build a monopoly and then jack up prices has been destroyed by the arrival of open-source competition. This pie chart shows that over 60% of the AI traffic from American firms is now routing through Chinese open models. These models are often comparable to American flagship systems, but can be downloaded for free. You cannot maintain a monopoly when the competition's business model involves not charging money. Second, the intelligence has escaped the building. Techniques like distillation allow massive models to be compressed into small, local versions that run on a home server or a desktop. Why pay a premium monthly subscription when a free brain in a cupboard can handle the boilerplate code and emails for the cost of electricity? The third failure is the most significant. Replacing a human is much harder than the profits claimed. Today's AI is a probability machine, an intern with amnesia who is prone to hallucinating facts and making confident errors. Customer service was supposed to be the easiest win, yet over 70% of AI service agents have reportedly been shut down due to mistakes. Companies that laid off their human reps early found themselves frantically hiring them back once the AI began face-planting in front of customers. The industry needed to replace 10 million workers a year to meet its financial obligations. Instead, optimistic estimates put actual job replacement at under 100,000. The technological miracle missed its revenue target by a factor of 100. Notice how the messaging is changing. The same leaders who spent years promising a job apocalypse are now using softer language, talking about workforce augmentation and empowering workers. This shift in vocabulary is the sound of an industry slashing its internal sales forecasts in public. The apocalypse has been postponed because the apocalypse isn't making any money. While their growth slows, these companies are rushing towards stock market listings at aggressive valuations. They are trying to go public at the exact moment the data shows they are hitting a wall. At the same time, these insiders are asking the government for loan guarantees and financial backstops. They are pitching a historic investment opportunity to the public while simultaneously asking for a taxpayer safety net. This is the final phase of a bubble. The people at the top see the math failing, so they head for the exit, looking to hand the bill to someone else before the music stops. In this stage of the cycle, the insiders cash out at the peak while the story is still beautiful. Retail investors often become the last money in, buying the narrative at the precise moment the storytellers are selling their shares and exiting the building. The most expensive machine in human history failed to make the workforce obsolete. This failure happened because the cost of supervising the AI and fixing its errors meant that replacing a human worker simply couldn't generate a profit. You outlasted a $1 trillion bet by being too expensive to replace.